You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Brent Donnelly. Brent is the president at Spectra Markets, which is an FX focused firm. So Brent, thank you so much for being on the podcast. It is awesome to have you here. He's also a currency trader and he's written two awesome books. One is called The Art of Currency Trading. The other one is called Alpha Trader. Both are brilliant. So, thank you so much for being on. It is awesome to have you, man.
Sure, man. I'm happy to be here. I definitely admire your ability to get so many people engaged at such a young age and to find your path so quickly is very impressive. So I'm happy to be here.
Thank you so much. Yeah. And so, the first thing that's on everyone's mind is sort of one, the Fed, and two, what happens with inflation. And so, the interesting perspective that you bring is, you're not an economist, you're a trader, you're a practitioner, and you focus on FX. So, how are you thinking through one, what happened with the Fed last week? Because if I remember from your AMFX note, that was relative to expectations kind of dovish, but at the same time, the market just keeps selling off. So, how are you thinking through what the Fed is doing and, how inflation, economic growth go from here?
Yeah, well, I think it's a really interesting time actually, because generally the big complaint about the Fed is that because of the asymmetry, the way they ease super fast and then they tighten very slowly, they're always tightening at the wrong part of the cycle because they wait so long that by the time they're tightening, the cycle is probably losing a bit of steam anyways. And so the really interesting thing now, and this is something very new that I just wrote about it today, and it's kind of like a new theme that I'm on. And yeah, just to explain, you said I'm not an economist. And so the way that I look at the economy, because I do look at it a lot, and I mean, I took economics, but I'm not an economist, is that I try to more look at where we are and where we are relative to the narrative. So, I think there's a lot of, if you read something like super forecasting or any kind of research on forecasting, economic forecasting is almost impossible. There's a lot of empirical evidence that shows that private or Fed forecasts are not very reliable. They're mostly extrapolation and they don't tend to catch the turns. And so what I try to do is identify the faster moving data and then also that in combination with sentiment and narrative to try to identify where we might be in the cycle and get a little bit ahead of the turn. And I think actually the Amazon statements about being overstaffed were kind of the start of a little mini cascade of, Cameo is a tiny company, but them laying off people, Facebook tightening things up, Netflix is stopping pay rises or paying much less aggressively. So what you have is a tech cycle that looks very much like where we were around, let's say June 2000, where the stocks had already crapped out at that point, NASDAQ was already down 65% or something. But employment was still strong. So employment's very lagging, depending on what indicator you look at, unemployment rate is completely useless. It lags so much that people say well, we can't be, the economy is strong because look at the unemployment rate. It lags so much. The unemployment rate even lags claims by almost a year. So I would encourage your people, your viewers, to ignore the unemployment rate. It literally means nothing. It's telling you the past, but it's not telling you the future. So what you had in 2000, 2001 was the stocks went first, and really the data didn't, it was clear there was layoffs everywhere. There was so much overbuilding and CapEx overbuild and malinvestment at that time. It was clear that things were over by like April, May 2000. And yet the jobs data was still strong for way after that. And I think we're kind of in a similar dynamic now where it's kind of clear that you have like there's usually the three engines approach, which is like Asia, China, Europe, and US. And you have two of those engines faltering badly, and the US still looks okay. But to me, we're right around the peak, I think. So peak jobs, peak inflation, peak everything. So I was actually writing today about, I think also that means peak yields. And conveniently, to me, the target on tens was always like 304, 325, which were the two previous yearly highs. And we got kind of right in there, like I don't know, what today was 320. So I think we're at an inflection point in the economy. And, that can mean different things for markets. Right now, it's bad for markets because there's no Fed put. And, at some point, inflation will come off enough and then it'll be good for the markets. But right now, bad news is bad news because the Fed put is too far away.
Got it. And when it comes to thinking through possible, I guess, FX trades, with this sort of idea in mind that the U.S. economy is sort of at a pivot from what was an upcycle to what is potentially going to be a down cycle. So, you said peak inflation, likely peak growth, peak unemployment, stuff like that. How are you thinking through, potential trade ideas for this, considering your views on yields as well?
Yeah, so like I said, today's really like the day that I kind of came to this conclusion as a combination of where rates are and then what's been going on. And so I went short CAD yen today actually because if rates are peaking, the yen trade should be peaking. Like dollar yen and yen crosses have been driven by the global rates trade. And then at the same time, Canada's probably the most sensitive to higher rates of the major G10 economies. So that means that like if rates are going to start giving back, and part of that is because of pressure on the consumer, because of high gas prices, high mortgage rates, high home prices, all that stuff. If that's what's going on, which to me that's what it looks like is going on, then Canada's probably going to suffer the most. And the crazy thing is, like, look at where oil is, look at where rates are, and dollar CAD couldn't even barely get below 125. So the Canadian dollar hasn't really like done all that well as a cyclical currency in a raging reflation trade. Canada didn't actually trade that great in the first place. So I'm thinking CAD yen, which like I went short at 101.20 today. It's a little bit lower now. I think we could be going back to like 97, 98 on CAD yen. It kind of combines all the views that I have, which is weakening US or peak usually bad for Canada. Like Canada tends to be levered to the US. And then Canada rates have priced a ton and have gone up a lot. And then Canada hasn't performed as well as it should have anyways as a currency. So you kind of have like, probably that's like a sign of underlying structural weakness, and extreme rate sensitivity, right? Because Canadian household debt is just monstrous. And that never really matters until you have to actually start, making payments at higher interest rates. So like at zero rates, you can have as much debt as you want and the payment's still going to be super low. But now with rates off the floor, that threatens like the Canadian consumer's budget. And I mean, these are pretty big picture things. And like, I'm much more short term. But what I'm looking at now is like you have all these kind of things stacked, and then you're waiting for an entry or some kind of timing. And to me, like the US 10s getting to the target, and then the Amazon and all the tech stuff. And if you're on like VC Twitter or tech Twitter this weekend, people are getting nervous about, layoffs and stuff. So, so that's my view right now. And like I said, like I kind of look at the whole macro environment, and then I try to drill down and try to find like surf the changes more than the levels. Like I'm always about change, not levels.
Right. And so, and so the other thing, as you mentioned, is that, you tend to be more short term when it comes to trading. And so, you sort of discussed the big picture view, and then you trade more short term. So how exactly do you go about, drilling that big picture view into, what are more tactical, shorter term horizon trades?
Sure. So like, I guess my overarching but like the way I look at markets is that the price of everything is kind of like the equilibrium of all known information. And then as new information starts coming in, price doesn't instantaneously react. So if you have some kind of view on like, okay, the existing equilibrium is this, and I understand like all why markets are roughly around here and what people are thinking, but then new information starts coming in, then you can start to look at like, okay, positioning and technicals kind of indicate to me like target reached in US 10s. People have been long the reflation trade for a while and are kind of like in denial now, I think, as commodities are coming off, like especially copper. Oil stays bid and I'm ignoring it because like I think there's more of a Russia story there and European energy and substitution and stuff. So I don't think it's a good reflection of global demand. It's more of a supply story. So as new information comes in, if you have some kind of edge in understanding like what the prior equilibrium was, what's positioning, and then where are we headed as a new equilibrium, then you can kind of trade that change in dynamic. And I think right now is a good example of that, where, you know, people are still a little bit stuck in the old reflation trade. I mean, one thing that's absolutely amazing is that because of the yen and Swiss moves, FX carry has actually done pretty well this year, which is kind of surprising in a big equity sell-off. Usually FX carry doesn't do that well. So I think people have kind of been lulled to sleep by that. And there could be a pretty decent pain trade as that unwinds. So I'm always thinking about like starting with the global macro and then trying to find, like, once I have my view, finding the sort of more bottom up way to express it. So like in this case, you could be like long treasuries, short Kiwi yen would make sense, short Canada yen would make sense. And then I try to drill down and go like, okay, out of those three, which one do I like the best? And then in this case, it's Canada yen, just because I feel like Canada is more levered than the US, like the consumer's more levered to higher rates. So the pain from higher rates comes more quickly. And, you know, the pricing is just the same as the US. So you get more pain from the higher rates and you're coming from just as high levels. So like the damage can be a little bit more severe in Canada, I think. Although generally what I find is when I have these trade, like, you know, essentially it's a call on yields that I'm making, that sometimes you kind of see it's all one trade. Like right now, mostly if I'm right on 10-year yields in the US, I'm going to be right on CAD yen because the correlation is so high.
Got it. And so how much of the CAD yen trade is actually the commodity story versus, versus the yield story? So, one thing that a lot of people have talked about is that both Europe as well as Japan. So, and obviously in this case, specifically Japan. So they import a lot of commodities, and so therefore they're susceptible to higher commodity prices a lot more than say Canada is, because Canada is just in general a commodity producer. So, we produce wheat, we produce oil, stuff like that. And so, seeing that commodities are taking or are having a pullback at the moment, how much of the CAD yen trade revolves around commodities versus yields, and how do you think about that?
Yeah, so it's definitely been a combination. And then the tricky thing is that commodities have been driving yields a lot because, higher commodities have been higher inflation. If I thought commodities were going higher, then I would definitely not like this trade. I'm not like raging bearish commodities, but I do feel like it's a little tiny bit, like it's nothing like '08 in many, many ways. So I don't want to like make a statement like this is like '08 because it's not. But there is some similarity in terms of the amount of financial money coming into commodities has been, in my mind, kind of excessive. And commodities markets aren't that big. So I feel like it would be pretty easy to get a correction. I mean, we already had a correction to 93 in NYMEX crude not long ago. I could see easily that all the pressure from liquidity withdrawal would flow through to commodities. Like I wouldn't be shocked if oil is at 93 a couple of weeks from now. I definitely think that's the weak side as liquidity gets withdrawn, and a lot of specs are long a lot of oil and energy equities. So I generally try to avoid any trade where there's crosswinds. So like, as you correctly pointed out, rates and oil basically have been the drivers of dollar yen and yen crosses. So the importers have been buying crazy amounts of dollar yen in Japan, less so recently, but in general. And so if I thought oil was going higher, then I probably wouldn't do this. I would try to express it a different way, or I'd just wait. Because what I want really is like all the dominoes kind of lined up, and not like, you know, 3 bullish reasons, but then they're kind of offset by 2 bearish explanations. So like, you know, if you think of a simple like pros and cons list, I try to do something like that either in my head or explicitly in Excel or whatever, and list like all the reasons I like it, all the reasons I don't, and try to be as honest as possible. And I feel like before you have the trade on, you can be pretty honest and pretty unbiased. Like I feel like confirmation bias comes much more strongly when you have risk on, because like then you have sort of skin in the game. You have like endowment effect where you own the idea and you want it to be right. Whereas beforehand, I feel like it's easier to be honest. So I usually list like, okay, here are arguments in favor of my trade. And like, if I was arguing against it, here are my arguments. And so like, if I was like, yeah, it feels like supply still a problem in oil and oil might go to 120, then I probably wouldn't feel comfortable with the idea.
Yeah, got it. And so it really is, so that's sort of like both rates and commodities are, you know, just driving the trade. And you know, when it comes to you know, when I read your AMFX, so there is a lot of focus around rate differentials. And so, you know, when do rate differentials not matter? And you know, when that sort of scenario happens where rate differentials stop driving currencies, at least temporarily, you know, what do you start looking at?
Yeah, so that's a good question, because like whenever I get into anything about correlations, you know, people tend to say, well, it's not guaranteed to work in the future. And absolutely, for sure, that is true, right? Correlations are not stable. With rates specifically, you know, there's a very strong underlying logic why higher rates attract money to G10 currencies, because the central banks are fairly credible. And generally people want to earn higher yields. If you're benchmarked as a global bond investor or whatever you want, you're going to always be at the margin attracted to higher yields. So I always feel like that's the default. And like, as far back, I really started getting more into correlation around like 2004. And since that time, you can pretty much almost always go back to rates as like your default, but there's very long periods where it doesn't work, and then specific pairs where it stops working. Sometimes it's because like with the UK, where rates were going up, but they were kind of going up like in a what people perceived as the most stagflationary situation in G10. So when you have higher rates and lower growth, then rate differentials can be misleading, because you know, those are bad rate increases, not good rate increases. And generally, usually rates are going up being driven by some mix of growth and inflation, not just pure inflation and possibly negative growth. So that's an example where I would try to stay away, where like you have to think about the underlying reason for that correlation to exist, and then like what's driving it right now. So in this case, the correlation exists because money tends to go where there's growth and yield is most, and yield. Yeah, but usually there's an underlying correlation that is there's growth there, right? Usually growth and yield are moving together.
Right.
But if you have growth is bad and yields are going up, then that would be a case where I'd be like, okay, I'm turning off that. Like I have like my things that I flip through, and like ages ago I turned off the sterling one, because like it's just, that's not going to be a thing that makes sense to me. So I'm always like a proponent of trying to figure out what's the underlying reason for the correlation, and then adjusting based on that. So like now Canada has been less correlated to oil, because normally when oil goes up, that's a bullish global demand story. But now when oil goes up, it's more of a like bearish supply story, right? Like it's a supply problem, not a demand, not strong demand. So that would imply to me that the correlation to CAD should be a little bit lower, because Canada is like a cyclical growth currency. So if your oil rise is obviously good for Canadian GDP, but it's not signaling strong global growth. So that would be another example where I'd kind of downgrade that correlation in my mind. Like, yeah, it's still there because of GDP impacts, but the real message from higher oil usually is strong global growth, and that's not the case. And actually that then goes through to like the SPX versus XLE correlation is almost always positive generally in the past, and it's negative now because higher oil is like means higher gas prices and weaker consumer to a lot of people. So I know that's a kind of a long answer, but generally I think when you're trading correlations, you gotta first like not overcommit to them. Yeah, don't overcommit to it in the first place because they're very unstable, and try to understand the why, not just the what.
Exactly. Yeah. And speaking of that, you sort of described how first off, growth and yields tend to go up together. So higher growth, higher yields, and then that again drives currency flows, because people would much rather own something yielding 5% rather than something yielding 3%. Just
right.
Everything else remaining constant. So does that still hold in today's market, considering that yields are going through the roof in say the US? But as you pointed out, what we might be seeing is sort of a shift in the cycle. So where growth is actually starting to slow down, or growth is we might very well go into a recession, considering that, for example, Q1 GDP growth was negative. So is that something that still holds in this market, or how are you thinking through that?
Yeah, I think it does hold generally, because the reason rates have been going up in the US up until very recently was because growth was very strong, and rates haven't gone up that much around the world because growth has been weak. So like if you look at rate differentials like US versus Germany, the US has benefited from being the only engine of growth. But like you said, and like I said at the top of the show, I think that's kind of coming to an end. So like if I had to choose, I'd be more comfortable short dollars right now. Although what I'm doing now is CAD yen. The beta from CAD yen, a lot of it comes from dollar yen.
Yeah, got it. And so one more thing that a lot of people just in general have been talking about is the euro. And so the euro is sort of susceptible to a lot of things here. So one is that the eurozone is a big importer of commodities, both energy as well as agricultural commodities. And so roughly speaking, we've seen the prices of both generally go up. Obviously, over the last couple of weeks, they pull back, but just generally speaking, natural gas, for example, across Europe is ridiculously high. And then the third is being susceptible to shocks from the Russia-Ukraine crisis, and having that direct connection there. And so a lot of people have been arguing that the euro US should head to parity. And so what are your thoughts on that view, that EU or USD goes to 1?
Yeah, so this always comes down to the problem of changes versus levels, right? So like what you're describing now is a bunch of things that have been pressuring euro for a while. And so then the question is like, what's the delta of those things going forward? Like, is the energy crisis going to get worse? I mean, possibly, right? If they're slowly cutting off Russia, so my view anyways, just to kind of like summarize it, is that things in Europe are very bad, like sentiment wise, current account wise, flows wise, but I feel like a lot of that is priced in. So I'm not really, the thing is, so if you're talking about euro dollar specifically, I just feel like we're pretty stretched in terms of the narrative in Europe, very bad, versus narrative in US has been very strong. And I feel like that decouple is like kind of at max now. So like euro, I think is bad, but I think the US is going to be less good going forward. And that probably means that euro dollar puts in a base, but things like something like euro yen could go much lower still, because, relatively speaking, there's still a lot of room for Europe to suffer. So I don't see, and also like one thing that's kind of been keeping euro bid on some of these like crazy spikes higher is the expectation that the ECB is going to hike June, July, somewhere around there. And to me, that's very similar to the Bank of England scenario, where like they're hiking to be polite, to kind of like give a nod to their mandate, but they're not really serious about embarking on like a serious hiking cycle. So I feel like Eurodollar is going to be more just like bouncing along the bottom here. I don't see a reason why it needs to go to 100. It's done a lot of work. Like, I mean, this year, where did we start? We started at 115, having come from 120. So I think it's done a decent amount of work, and I'm not really convinced it goes much lower, to be honest.
Gotcha. And yeah, one more thing is that at the start we discussed, so there are sort of three engines to the world economy. So you have the US, you've got Europe, and then you've got Asia, Japan. And so when it comes to we sort of discussed the US, and now we just discussed the euro. So when it comes to Asia, broadly speaking, how are you thinking through what's been going on in China with the Chinese yuan? And so that is something that that is again something that's on everyone's radar at the moment. And so we'd love to get your thoughts on it.
Yeah, it's really interesting with like we usually trade CNH, that's the offshore. And people have been bullish dollar CNH since like last September, right? When Evergrande was happening and real estate was unwinding. And the tricky thing with trading dollar CNH is that it's a policy tool that the PBOC uses like as a monetary policy tool. And then they're also running kind of two different models. So like the main model that they run is called CFETs, which I'm sure you know, but just for anyone that doesn't know, which is essentially a basket. So they're managing their own currency against a basket of a trade weighted basket of partners. But then the market tends to look more at dollar CNH. So you kind of had this combination of China was worried about the topside inflation in commodities. And so they were keeping their currency very strong in order to protect against that. And then very recently, in somewhat like to me, what looks kind of arbitrary timing, like people have been bullish. And so now everyone's saying, oh yeah, this totally makes sense. But like it made sense last September too. But in the last couple of weeks, they basically let it go. So we've gone from 635 to 675, which is a very big move. It's one of the bigger moves like in the last 10 years. And so usually then it becomes a guessing game as to how much will they let it go, because and eventually they will intervene and slow things down. Last couple of times they did this. So in 2015, they devalued. And then during the trade war, they kind of let it slide as well. They capped it at 7 a couple of times. And to me, that kind of makes sense for this move. Like we kind of go to 7 and then we see. And then there's two outcomes. One, they just continue to let it devalue. Or sorry, there's 3 outcomes. One, they just continue to let it go, which I think is unlikely. 2, they'd cap it there for a while and things settle down. And people just kind of get bored and it drifts lower. That's what happened in 16 and 18. And then the third one is they lose control of it, because that's always a possibility that there's been many examples of it looks like the central bank is controlling the currency and then kaboom, they're not. And usually the way that they control the currency, if they're in trouble and they're losing control, is through rates. And they definitely don't want to be hiking rates right now, given where the economy is. So yeah, there's some question. I think it's like a 20 delta that it could go to 7 and then they just lose control of it for a while. So people are playing that in the hedge fund space, especially because it just makes a ton of sense. Like there's no reason why dollar China should have been at 635. The only hard thing was it just stuck there for like 5 months. So it's been a very difficult trade, but now it's finally yielding some fruit.
Yep. And yeah, so one more moving on, I wanted to talk a bit about trading process and one thing that when you think about FX and macro trading in general is that there were a lot of proxy trades. And one thing that Alex Gurevich in his book, The Next Perfect Trade, has touched upon is this idea of a dominant trade. So when you have a view, so let's say that your view is, just hypothetically, is that commodities are going to go lower because global growth is slowing down, and so there are just many different ways to play that view. So you could, for example, short AUD USD, or you could short AUD JPY, or you could short CAD JPY. When it comes to thinking through that, how do you go about and figure out what the dominant or the superior trade is?
So first of all, I tend to stick to FX because I'm a believer in having as much broad knowledge as possible, but then executing in a more narrow way in things that you're expert in. Because I think having like a knowledge of microstructure and flows and things like that can be very helpful at the margin. So I tend to stick to FX. And what I try to do is essentially like start listing reasons why this is a good or bad idea. And so if I have like, you know, multiple currency pairs in a spreadsheet and I start listing, then I'll be like, okay, positioning, you know, is a tailwind in this currency, but it's a headwind in this one. Commodities are a tailwind here, you know, like based on this, is it a cyclical currency or funding currency? Then you slowly start to kind of put down all, and then you look at the countries themselves. Where are we in terms of monetary policy? So kind of like the nature of the currencies being like high beta, low beta, commodity versus not commodity and stuff like that. And then the direction and level of monetary policy. So like Canada's tons is priced in and they're kind of like further along in the cycle, whereas like Australia, they're kind of earlier in the cycle. So that could mean different things at different points of depending on what my view is. But essentially kind of going through and then also going through like, okay, what's the entry point? Like, what's the location look like? If you look at like Kiwi versus Aussie right now, Kiwi's sold off a lot more. So maybe that's a more attractive entry point. I mean, it depends on the situation. So like going into the technicals as well. So like pretty much going through my framework, which is, you know, fundamentals and then positioning, technicals, microstructure kind of things, depending on what I'm doing. And then like my perception of the flows and perception of the narrative relative to the fundamentals is usually important for me. So I kind of go through all those things and usually then just like the best idea pops out. And sometimes it doesn't actually. Once in a while, I'll be like, okay, I don't really, like, I don't want to be long yen, but I don't know what numerator I really want. So then I'll just do a basket. But that's more rare. Generally, I try to narrow it down to like one or two currencies against one other currency. And then, and if I can, I'll do the basket, but that is probably like 20% of the time. Usually I can narrow it down.
Yeah, I see. And yeah, you know, one aspect of your framework that you just mentioned was positioning. So are there any places in the market at the moment where you're concerned about, I guess, concentrated positioning?
I think actually yen right now is sneaky. Like people have kind of missed the first big move. So the positioning was really light, but then after the last BOJ meeting, it was kind of like the green light to go after yen weakness. And if you look at the move since then, it's actually been very small. Like I think I don't have the chart in front of me, but if I recall correctly, I think it was dollar yen was 128.80 after the BOJ meeting, and now it's or sorry, before the BOJ meeting, and now it's 130.25. So pretty much the whole move after the BOJ is kind of like it happened on the day of the BOJ, and we haven't really moved much since. And US rates have gone up a decent amount since then. So to me, that's kind of showing people piled in at pretty bad levels. And now the risk is there's probably a decent amount of downside. So that's kind of playing into my CAD yen view, is that I think dollar yen has got kind of crowded. And if it's crowded via options, it doesn't really matter. Like that usually just caps the top side. But I think in this case, it's more crowded in spot, which if something's crowded in spot, then that usually means like more convexity to the downside. So like if markets long 135 strikes, that doesn't mean it has to go down fast. But if markets long cash, which I think they are, then that could potentially open up the downside, say to 127 or something in spot.
Yeah, and you know, as you talk about yeah, and so the other one that I wanted to quickly touch up on was cable. And so one thing that you see is that if you look at the non-commercial GBP shorts net, the market is actually quite short GBP, and I don't know, does that concern you at all when you look at GBP?
So no, not really, because so there's a couple things. One is generally the CFTC data is pretty trend following. So it mostly means that trend followers are short. And the other thing is they're short at good levels. So they've kind of been selling like since 130 would be my guess. So I don't feel like there's, and also the price is so far away from the moving averages that like they're not going to be cutting anytime soon. So if I look at like at the specs who would be more like liable to cut, I don't think they've participated all that much because kind of like the CNH trade, it made so much sense to be short cable for a long time and it never moved. It was just hanging around at 130. And then it kind of went whoosh and left everyone kind of a little bit offside. So I feel like CFTC is like, I'll look at it, but if you back test it, it's actually better to go with the direction of the positioning, not to go against it. So if you're using it as a reversal indicator, you have to have a catalyst or like even just like a technical break or whatever, but like just mechanically going against the CFTC is a money loser. And so right now I feel like this is a typical reason, like a typical time when you would not want to go against the CFTC data because the positions are deep in the money with a lot of momentum and the story's still pretty strong. So I'm not like, I find it a little bit hard to be short cable now because it's moved so much, but I think it's the right trade.
Yeah, got it. And so as you mentioned, when it comes to when it comes to positioning data, so how do you actually look at positioning then? So because most people, when they think about positioning, their first idea is to go look at the CFTC COT report and then go from there. But as you mentioned, that tends to be, these are speculative, tend to be more or less trend following. So how do you go about tracking positioning?
Yeah, so this is like a big topic that I write about a lot because I feel like the number of times people ask me about positioning every day, like clients and stuff, is way over the actual importance of positioning. So generally my kind of like long story short on positioning is it almost never matters, but then when it matters, it can be like the only thing that matters. So determining those points is really difficult but also important. So like obsessing over positioning, which a lot of clients or people do, it's just like generally not a useful framework for FX because the macro and the flows and the current accounts and all that, those can drive things for years sometimes, and positioning will be the right way the whole time. Like the biggest example ever is Abenomics, where like the market was long dollar yen for 3 years and it went up 60% or whatever. So that's like a very extreme example, obviously, because that's like one of the biggest macro trades of all time. But I will say generally that what I look for are like the super mega extremes. And I don't really find those in CFTC because it comes out once a week. It's, kind of generally trend following. It's hard to adjust for like, is the futures market just getting bigger or is the short actually getting bigger? So the things I look at more are things like DSI, which is like a survey of retail investors that comes out every day. And that back tests pretty well if you get to the extremes below 10% bulls or above 90% bulls. And then honestly, I sometimes just look at things like deviation from moving averages. So like if you do the difference between the 100-hour moving average and spot, you'll see that in a lot of currencies, it tends to have a particular place where it just gets overextended. And then I'll kind of match that with like, okay, because I'm working in a business that interacts with a lot of FX traders, I kind of have a sense from just talking to people as well. And you can get that sense from Twitter as well, I think, in FX, because I don't think Twitter's that biased. So I'll look for basically the super extremes, which to me is like each currency a couple times a year. That's when I'm really getting excited about positioning. And mostly what I feel like positioning is a trend following, it's a series that follows the price. And if you overlay positioning to price in any security, that's generally what you'll see, is that positioning goes with price. So if you are fighting positioning, generally you're fighting price. And what you want to do is find like, okay, now we're 3.5 standard deviations offside in positioning. That's when you want to get involved. And you can sometimes see that in like, another way to do it is to track the Sharpe of the trade. So like if something's generating a persistently high Sharpe, it's probably getting crowded because, the things sort of like the algos and that and trend following systems are tuned for, following high Sharpe trades. So that's another way of looking at it. And I know this answer isn't like super helpful, but the real way to know about positioning is by talking to people. So you get an impression, like when I send out a trade idea and I get like 10 angry responses, that says more to me about positioning than like CFTC or anything like that ever would.
Yeah, why are you short CAD JPY right now?
Yeah, dude, don't you know Canada's booming?
Exactly. Yeah, I can see that here. Yeah, no, for sure. Okay, yeah. So one more thing that I wanted to cover was when it comes to when it comes to your idea of, you just spoke about extremes in positioning, and when it comes to thinking through those extremes, how do you ever go about taking longer horizon trades? Because most of your trades tend to last a few hours to a few days at max, maybe a week or so. So do you ever tend to play those longer trends, which may last for several weeks? For example, we've seen that in for example, euro US dollar. We've seen that in dollar yen. We've seen that a bunch of this, at least this year. So do you ever tend to play those longer term horizon trades?
So sometimes I'll go out around a month or so, but I feel like generally that's just not my edge. And so the thing that having a longer term view does is that it constrains me in terms of my like nimbleness or my flexibility, and I don't like that. So I will sometimes have the same view generally for like a month or two, like sell rallies in euro or whatever. I might even have that for like 3 or 4 months. But I won't usually hold the trade because I'll tend to reverse at oversold points, and I'll tend to take profit and then try to resell. And that can be a negative for sure, because like sometimes I'll make 2% on a trade and the guy next to me makes 7% because he just sat with it. But I think part of it is like knowing what you're good at, and I'm not good at that. And part of it's personality. Like I'm impatient. Like I just tend to not. I'm not good at putting something on and just sitting with it. I'd rather take profit and then try to sell the rally and have more leverage on the rally. So yeah, generally I just feel like, having dabbled with that in the past, it's not what I'm good at. And it just like, I think part of trading is recognizing like what you're good at and what you're not. Yeah.
Yeah. And
it definitely costs me sometimes though. Like definitely, like obviously I miss things, or I don't hold on long enough, but that's just the way it is.
Great. When it comes to sizing your position, so how do you think about sizing these shorter term tactical trades?
So I always start with the amount of dollars that I want to risk. So that's based on conviction, and my conviction levels are pretty like lumpy. Like I don't have like this long, like 10 different conviction levels. I basically have like, it's a ding dong trade that's just like some random correlation thing, which is like type 1. Type 2 is like 80% of my trades. And then type 3 is like, this is a gigantic opportunity that the setup's perfect. And I'm in a strong position because I already have a lot of P&L. So I'm kind of like going all in on the trade. Those are basically my 3 levels. And then based on, how my P&L is, I have a percentage of free capital that I allocate. So then I'll have a dollar amount that spits out of my spreadsheet. And then I go, okay, what's the correct stop based on the market? And then my position size just is a plug based on that. And so like, I'll never adjust like a position based on trying to, like, I never go the other way and say like, okay, I'm going to put my stop here because I want to risk that much money. I think that's backwards. You always want to pick your stop based on market reasons. And then if that means you have to have a smaller position because you're like, if the logical stop is really far away, then so be it. You just have a smaller position. And so my position size is basically a function of conviction level and then where my stop is, and that's it.
Yeah. And then, yeah. And one last thing that I wanted to touch upon was, you spoke about when we started the podcast, you said that you tended to you believed in having a broad base of knowledge. So one of the things you mentioned was microstructure, and obviously my boss Mike Green, he's talked a lot about he's sort of an expert on that. But just in general, when it comes to FX, so ever since Dodd-Frank was introduced and the prop trading desks were more or less kicked out from big banks, how has the market changed since then in terms of microstructure? Do you see, are there like liquidity problems? Some people have blamed that, for example, sell-offs in equities, etc., have become more extreme since 2008, partly because you don't have prop desk, you don't have other people, you don't have that big source of liquidity trying to buy in to those kind of dips, for example. So do you think those sort of arguments are valid? Do you think that microstructure has significantly changed since 2000, or do you think that it's relatively the same? There's not much of a difference.
Yeah, it's changed a lot, but I don't think it's because of Dodd-Frank as much. I think it's more because of the rise of algos. So what you saw, like when the algos first started to really become prevalent, was, a lot of subtle changes in behavior, which like Stan Druckenmiller has spoken about before and stuff, is that things don't trade the way that you thought they would. Another thing that happened was correlation trading became much less profitable because algos are really good at that.
Brent makes all the money, so.
Yeah, well, I used to, but it's harder to make money correlation trading now. So the algos definitely changed that. And then one thing that you saw a lot was a bunch of flash crashes from like 2010 to 2015 and like all kinds of in FX rates, stocks. But I think a lot of that's been cleaned up. Like a lot of that was just poorly designed algorithms that had market logic. Like, if this happens, go to market and do this, which can be catastrophic if the market's like 500 points wide in cable or whatever, as we saw in the flash crash in cable. So I think that has been cleaned up. But so the algos have introduced many new nuances over the last like 10 years. I'm not as much of a believer in something like single name credit, like Dodd-Frank would have a big impact because dealers are making prices and they're critical market makers. In FX, it's just so liquid. Like it's such a huge market that, prop traders' contribution to the overall liquidity pool is pretty small. You have so many like actual trade balance users of FX, for example, like corporations and borrowers and lenders and all that there's like a very strong sort of underbelly of liquidity that's always going to be there in FX because of the trade flows. So it's just not as reliant on speculative liquidity. Specs add liquidity sometimes and they take away liquidity sometimes. I feel like algorithms are the same, that like when nothing's going on, algorithms make it very deep, but then when the shit's hitting the fan or when there's a regime change, the algos completely disappear because they're not obligated to make markets. So to answer your question, I don't think FX liquidity has been impacted very much. And honestly, the behavior of desks hasn't been altered that much either because of some of the market making exceptions and stuff like that.
Yeah, I see. Brent, to wrap up the podcast, I wanted to ask you, so what do you do could you tell the audience a little bit about what you do at Spectra FX, and then also a little bit about where they can find your work, as well as the books you've written and your Twitter?
Sure. So there's a company called Spectra FX Solutions, which has existed since 2007. And their business model is as an agency acting as a middleman between banks and hedge funds for FX spot and derivatives. So I joined that company, but then they also started a separate company for me called Spectra Markets. And the idea behind that is because I've been writing so much since like 2004, and I wrote the books. So the most recent book is called Alpha Trader, and you can get Alpha Trader on Amazon. That's the best of the two, unless you specifically want to learn about FX. But so in order for me to reach a bigger audience, we set up this company called Spectra Markets, which is essentially a continuation of what I used to do, which is write about global macro, FX, crypto, and all that. But now through this company, I can reach a broader audience. Whereas working at a bank, which I did for most of my career, I could really only send my writing to institutional clients. So I started here in September 2021, in 2021. And the idea is for me to kind of reach a broader audience and expand my reach. And so far it's been good. So people can go to spectramarkets.com and everything's on there. There's some free stuff and then there's some subscription-based stuff.
Yep, got it. Awesome, Brent. Any closing thoughts?
No, I would say one of the most interesting things going on really now is just like the way all the correlations have gone to one, which is kind of typical of risk aversion. But it'll be interesting to see. I think the thing I'm watching most is when that starts to break down. Like when you start getting days where crypto and NASDAQ are not moving together, for example, or like rates and the dollar are not moving together. Because right now you just kind of have this period of all the correlations kind of go close to one. So those are kind of fun markets to trade and like somewhat easier in a way to understand what's going on, but to some people less interesting because there's not really much idiosyncratic stuff going on. It's just, either people are feeling risk averse or they're feeling risky, and that's about it.
Yeah. Yep, absolutely. Brent, thank you so much for being on the podcast. It was just awesome to speak to you.
No problem. Thanks for having me.